And welcome back to Africa News Network, First Fast Live. This is Biz Pulse with me, Cindy Mabi. The African Development Bank has launched the 2018 edition of its annual flagship report, the African Economic Outlook, at its headquarters in Abidjan. And the 140-page report highlights Africa's state of socio-economic performance. The Development Bank is the first to provide headline numbers on Africa's macroeconomic performance and outlook. And the report has found that after tepid annual growth of 2.2% in 2016, the average real GDP in Africa rebounded, reaching 3.6% last year. And the GDP is now projected to grow at 4.1% in 2018. The report says many African economies are more resilient and better placed to cope with harsh external conditions than they were in the past. It adds that among the continent's other larger economies, South Africa has a drag, or rather was a drag on growth in 2016, growing by 0.3%, while Egypt enjoy above-average growth with 4.3%. It also says the median rate of inflation rose sharply in Africa from 3.6% in 2015 to 5.4% the following year. Joining us in studio, Tsepo Hadima, a political analyst and economic analyst. Good to have you as always. Good evening to you. And why should we be excited about the Africa Development Bank's edition or the latest edition of its annual report on the Africa Economic Outlook? I know it's a newer version of it, or what's different?
I'm not sure about whether we can be excited about it, but one thing it points out is that we are still having very pedestrian economic growth throughout the continent, when in fact this continent, by and large, with the population that it has, with the underdevelopment, the under-industrialization that we have, it actually is ideal to have been growing at over 10% on average, in order to bring down the high levels of unemployment, the high levels of poverty that we see pervading the continent. And that would really largely be spent by infrastructure investments. We should be making infrastructure investments no different from what the People's Republic of China has done, whereby in the last 30 years, they have moved over 300 million people from living below the breadline into the middle class. Now, if we have 1 billion people in the continent of Africa, it is not possible for us to be able to achieve a better life for all of those people with a projected growth even at 3.6% or 4%. It just certainly out of the 54 countries, it points that the picture is a lot more bleaker. Now, if we bring it down to home in South Africa, and you say, well, what is the projected economic growth for the year 2018? You'll find that by and large is that we're going to be facing higher unemployment than what we had even the year before, as more industries are looking to shed jobs, but also that there doesn't seem to be a clearly articulated plan that says that growth of 1.1% that is projected for South Africa, what are the job numbers, or focus in terms of the job numbers based on the industries that will be investing in bricks and mortar. So those are the key things.
Before we come into the nitty-gritties of the economics and how, under the current economic climate, things can change, what about the skewed view or relations in terms of what comes in as aid to Africa as opposed to what is extracted in minerals and tax evasions and that is all these illicit cash flows and how they come into play? Will the DBSA economic report be able to reflect that these are the corrections that ought to take place in the trade relations, or even the dollar-rand exchange, and why the currency still has to be dependent on the sterling and the...
We have to take this into account, that the so-called aid that is given to Africa by the rich countries, and largely from the Northern Hemisphere and the Western countries largely, that aid doesn't actually get accounted for to the extent that it could. It doesn't have a multiplier effect. And what do I mean by that? So the aid can come in whatever form, whether it's food aid, or whether it's a form of, sometimes they even do consulting in terms of support, capacity building. The reality is that that money is actually accounted for in Africa, but is actually expensed in the country that is giving the aid, including the things that are manufactured. So aid, we completely take it out. When we look now in terms of the raw materials that are extracted from Africa, we are seeing that by and large, the jobs impact is exceedingly limited. We can take South Africa, for example. In 1985, we had over 750,000 people employed directly into the mining sector. Today, 2018, we have less than 300,000 people directly employed into the mining sector, even though we are told that mining still plays a much more significant role. So what we have seen is that as there is a lot more mechanization that goes into that industry, less and less people are employed, but at the same time, with the advent of what they call globalization, we have seen that the multinational corporations have made it their business to avoid and evade all manner of taxes in whatever form that the country where the minerals are extracted from should be deriving. So as a result, it is actually a double blow on the economy. First, in the first instance, in terms of jobs, formal jobs, that could have really been accounting for the sustainable economic growth with a strong consumer, because as people will have disposable income, they are able to spend in other areas domestically and therefore be able to account for a sustainable higher GDP growth. That doesn't happen. But the tax avoidance through transfer pricing, which I think just a few years ago, the number came out that it was over $52 billion US annually that gets taken out of the various countries within the continent of Africa. Now, we can also contrast this. GDP number itself is always misleading unless you juxtapose it with the jobs numbers. And for a very specific reason, not long ago we saw countries such as Angola, Nigeria, that are oil producers, even Guinea Equatorial, that were growing above 10% annually. And during that period of time, because what they were accounting for, even Mozambique, for example, at one time Mozambique was growing, the GDP growth was over 10% annually. And yet they were not a GDP growth that was creating jobs. South Africa also went through that phase where we were growing about 4% and at the same time we were shedding jobs. Because the question that you must ask is that, well, what is accounted for in terms of the GDP growth? And normally what gets accounted for in that basket can be misleading, that you can say, yes, we have got this healthier economic growth. For example, the African Development Bank now comes up and says the economic growth for Africa as a continent of the 54 countries, average will be, I think, 3.6%. Some of the countries, they will find that they are growing at 8%, but they're not creating the jobs. So as a result, direct result, because the oil services, for example, is accounted for in country, but is actually offshore, very little impact internally. So what am I saying? What I'm saying is that for us in South Africa, specifically, in the time where we are in, there are a number of things that we need to adjust in terms of our macroeconomic policy position in order to be able to achieve higher, sustainable economic growth that is creating jobs. And that, simply put, it means we must now not talk of the beneficiation mantra because it's a nice to have, but saying, what is it that gives us a unique competitive advantage? If we look in the platinum sector, South Africa hosts over 75% of the world's known reserves of platinum, and yet we play a minimal role in the industrial application of platinum, in the manufacturing of auto catalysts or catalytic converters. Now, that in the backdrop of what? China, for example, on average sells over 18 million vehicles annually. The United States sells over 17 million vehicles annually. All of those vehicles, they need a catalytic converter. So if we are manufacturing catalytic converters, meaning we would have a unique advantage in terms of cost and in terms of having the raw material. Therefore, even being able to take the recycled products and then using our bilateral trade relations with countries such as China to ensure that even though we can be in the assembly of various vehicles, which is only one in, I think it's like 1 in 7 cars, but if we are making will be a unique advantage for us. We'll create jobs. The same thing can be applied to agricultural sector, where we go beyond just
and I hate to interrupt you, but
but
in those policies, the microeconomic financial policies, do you think that there is an appetite both on business in South Africa that enjoys tremendous wealth that they then externalize and invest on various bourses on the international stock exchanges, that this is a likelihood that those kind of interventions to put South Africa first, to create the necessary, jobs and alternative industries?
Well, I think it's going to be difficult. One of the barometers to see how our economy would grow would be the activity of the JSE. The JSE, I think, has gone over 60,000 points. That just means that the people who already invested in it, they are making too much money, they are happy. But that is not money that is being raised to come into the economy, into the productive sectors. And that is in terms of listings, companies that will go to the stock exchange and list. We have not seen, we talk about Black Industrialist Program, for example, but what I've heard from would-be participants in the Black Industrialist Program is hoping and praying that government will provide loan funding for them to be able to get into productive industries as Black industrialists. And that certainly is a failed model. If the Black industrialists had organized themselves that they could be coming to the market, doing initial public offerings or new listings, not only on this stock exchange, but on other exchanges globally, yet they are registered in South Africa, because that will release much needed capital to then get into the productive industries. We are not seeing that happening. And government or the development finance institutions, the African Development Bank, by the way, is one of the development finance institutions, it's got exceedingly limited capital in terms of its balance sheet when we look at the 54 countries and how much capital in any 1 year it can be able to deploy. In fact, both the World Bank, the African Development Bank, the Development Bank of Southern Africa, the New Development Bank, which is also known as BRICS, all of them combined, they do not have enough capital pool to be able to give us the level of economic growth that we require. So that in turn means there has to be a level of realism within our policymakers in South Africa and say, well, what are we then to do in that context? And a number of things that I believe that they should have been doing, which they are not doing. Next week, they are going to the World Economic Forum in Switzerland. I have said it before and I'm saying it again. It is nothing but a jamboree paid for by the taxpayers, because they have not even been able to report back 2017 World Economic Forum, when they went, what exactly has it been able to produce? What projects are they taking? Who are the would-be investors that could be investing in this economy? And the other realism, of course, is to say, us as a country, as a territory, South Africa, any would-be foreign direct investor from Northern Hemisphere, specifically from Europe or the United States or North America, that could invest in South Africa already has invested. And we are not taking enough action to attract a newer form of investor. Now, China has come up, for example, with the One Belt, One Road initiative, or the Silk Road initiative, which is looking at unlocking over $230 billion US of investment that will be going into productive sectors, economic infrastructure. Now, we are not matching that, and there's even little talk from South Africa.
Talk us through, before we let you go, in the focus that ought to be Afrocentric, and selfishly so, because we do sit with the wealth of the world that is even untapped, for that matter, in those underdeveloped countries, as you mentioned. Why is the focus not on self-reliance and self-sustainability?
Well, for a long time, I don't know who has seduced our policymakers to always think that they need to be looking at borrowing for the budgets of the various government. You know, they run, most of them, they run large debts, or what they call budget deficits, because that's what they term to be a foreign direct investor, when that is not the case. One of the things we need now to be doing, for example, is to be unlocking local capital from within the continent. There's a lot of capital, but it is not harnessed, it is not organized to be able to go into economic infrastructure projects. You think about our neighbor, Zimbabwe, for example. I think that Zimbabwe would best do, instead of trying to attract a foreign direct investor, by actually creating a fund where they can issue bonds to Zimbabweans in diaspora, as well as those that will have solidarity with Zimbabwe, but to specify that such monies that they will raise with such a bond issue should go specifically into economic infrastructure development. The same thing we need to do here in South Africa. Intra-trade, for example. There's very little intra-trade. We've seen Uhuru Kenyatta, the president of Kenya, was here last week. Apart from the fanfare and the politics, there were no business people that met with these presidents who could then say, practically, what are the things that we can do? What is it that we can import from Kenya outside of coffee, which is great coffee, by the way, that they grow.
Second to Malawi.
Which is, well, they've got better. Starbucks believes that Mount Kenya's got better coffee. Anyway, apart from the coffee that will be imported from them, and then the wine that we will serve to them, is that, well, how many jobs have we been able to create there? Not many, because there are other sectors which we just haven't been able to tap into. In my capacity as the chair of the Indian Ocean Rim Business Forum, for example, these are some of the things we are concerned about. How do we ensure that we can now start to have intra-trade? If 70% of the world's trade is handled in the Indian Ocean, with 50% of the world's maritime traffic going through the Indian Ocean, and yet we have very little of it. For example, South Africa, we don't produce, and we should have been producing bunker fuel. Therefore, to ensure that all the traffic of ships that has to traverse here our waters, they can then be able to refuel, and then the seafarers will then be spending in tourism, business tourism, in terms of accommodation and a whole host of other services, including supplies for that traffic. And yet we are missing out because we have not invested in that. And so what we need tangible projects where we can clearly say, this is the number of jobs, this is the timeline, and this is how much resources, but also move away from relying on the development finance institutions such as the World Bank and AFDB as the only source of capital into those industries to be able to be developed, because they are not, and take advantage of what China's One Road, One Belt initiative is all about.
Okay, Tsepo, as always, great having you. Tsepo Khadima, economic and political analyst, joining us, saying that there is too much hype up around the Africa Development Bank Economic Forum report, or focus report, that more can be done in terms of trade with sustainable programming.